So you've been in the game a long time, Mike. I know you look at lots of things, technicals, options, but what can prepare us for this event? I mean, how do you even begin to think about markets right now?
Yeah, I'm glad to be on with you, Oliver. I must say that this is really, when I think about it, an absolutely historic period that we're living through. This is a moment that you and I and all of us will remember forever. They will write about last week and the next few weeks in textbooks. And it's rare to know that you're living through something as historic as this. Look at some of the data we saw. Macau gaming revenues nearly fell 100%. They fell 88%. Yeah. You have the 30-year dividend yield. You have 30-year yield over the S&P's dividend yield. That's only happened once in history. You have Costco lines. You and I saw them on Twitter. Costco monthly sales are going to look ridiculous probably when they report them. So, this is a really historic time, and I think we really need to figure out how we're going to navigate this.
So, Mike, the technical rollover that happened with such ferocity, usually you look at that and you go, okay, this is a time to buy a dip. Things got so-called oversold, but I thought Barron's put it well this weekend, which is you don't know if we got oversold or undersold, right? I mean, if the U.S. is the next one to grind to a halt, there's your number one economy, and surely that's going to hit the fundamental outlook even harder.
Yeah, and this is a good lead into one of the points I really wanted to make on your show today, and that is we have to do everything we can right now to take emotion out of our decision making. And it's really hard, obviously, with the news and the death toll and all of it. It becomes really, really hard on a day-to-day basis. The really best way, one of the best ways to take emotion out of your thought process is to rely on technical analysis, to say that price represents all the information that I don't know. So we want to find really good technicians. You and I know one, Helene Meisler. We want to find really good technicians and start to really kind of focus on their work, because we're looking for things like 90% up days, a couple of them in a row. We're looking for signals from the market that are pure price based that take the emotion out of our decision process.
Now, when you think about that, the idea of looking at this versus, company specific versus macro, I know there's going to be a lot of people who, use this opportunity to pull out the shopping list, find the names that were trounced. Right now, it seems like the market's been pretty indiscriminate. It's not really clear whether the, move is going to be led by big tech, if it's going to be led by cyclicals. Everything's kind of had its day here in the selling sun. It's a little bit interesting, Mike, that there's not real clear downside laggards or outperformers, at least from what I've noticed.
Yeah, and they say that in a crisis or in an event like this, all correlations go to one. You just start pounding everything. Gold, Bitcoin, staples, utilities, everything just gets pounded. Correlations just go to one. This kind of goes to another issue that investors should be thinking about. Historically, times like these, it's made sense to buy high quality companies with durable cash flows and play for the destination, not the path. Mm-hmm. That's important. People are going to try to play for the path right now, and they can't. They need to play for the destination. I know I did some calls with institutional investors, people in my previous world as an equity trader. They're using options to play the destination. They're sophisticated investors. They don't want to play the near-term ups and downs. They're saying, I want to buy some long calls on companies that I really believe in and not worry about the daily fluctuations. Now, that's what the institutional investors are doing. Retail, on the other hand, are probably just doubling down on the reason why they're in the market, for retirement or for college savings. The reasons that they're in the market are what keep them in the market. Two different mindsets, certainly, but both playing destination, not path.
Yeah, so the point is only dabble if you are ready and willing to weather some serious storms, because clearly this thing's not going away right now.
Yeah, and we want to see days where, honestly, I looked back at the Ebola sell-off, which is obviously different. This is a different situation. But in the Ebola sell-off, there were 3 days in a row where the market just got pounded. There was a day when it bottomed where it got pounded and then closed near the highs. It didn't close green. It just closed near the highs. We want to see some of those days where the market gets kind of pounded intraday but slowly works its way back. Friday might have been one of them. We want to see that kind of price action where really bad news starts to get shrugged off.
The metrics that we look at for degrees of selling, right? I mentioned kind of the rollover of RSIs, but volatility as well. I know you're an options guy. The fact that we were already got very deeply inverted on VIX. I mean, just looking at the way this curve flipped is pretty wild. I mean, it's already gone way past the December 18th. If you look at just 3-month VIX to spot. Now, is that something that we can use as sort of an indicator of when that kind of congestion clears and the capitulation trade happens? Mike? I mean, do we need to also kind of throw out our vol blueprint for what usually is a signal?
Yeah, I mean, I've sat in my office and thought, wow, some of the stuff that I'm seeing, people will say X the COVID-19 timeframe when in the future when they talk about the market. Certainly with the VIX over 40 has historically been a great time to buy stocks when that's kind of fear is expressing its highest levels. But like my original point, we're going to see stuff that I don't think that we'll look back on and say, wow, I mean, this is just incredible. The S&P 500 in the last 10 days fell from a 52-week high to a 52-week low. It has never happened in history. Wow. And it's just, we look at some of these things and it's just, you almost have to shake your head and shrug your shoulders and say, I don't know what the path is over the next few days. What used to work might not work, given the fact that literally economies could be shunted to idle speed. And I think that's why people are looking towards central banks for some support.
Let's talk about that. I call it the side pot that's forming because there, I think, is also some pretty big, betting happening on what the Fed does. Mike, on the one hand, we could say we know what they've done in the past, so let's use this as precedent and assume cuts are coming. On the other hand, prior to this, Jay Powell's very comfortable with the economic situation, said that they didn't really want to reverse, they didn't want to hike, definitely less interest in hiking than going lower, but are people getting over their skis on the expected move? I mean, we're looking at 3 cuts by the end of the year, according to Fed Funds futures, and 2 basically at any moment.
I mean, I think people are definitely getting over their skis. You might have seen it, but I saw it on Twitter last night. People were talking about the market pricing in cuts by 6 a.m.
Right.
It was just, there were stuff being thrown around that I can't believe. The real shame of this from Jerome Powell's perspective and the Fed's perspective is that economic data really was looking good to start the year. LEIs and new home sales both hit a cycle high within the last month. Those are great leading indicators. He's got to be sitting there going, I can't catch a break on this. Certainly the market, I like your side pot analogy, the market is pricing in those cuts by the next meeting. I don't think we get intra-meeting cuts unless there's just a rapid acceleration in the virus and the death tolls. I just don't see that being on their plate. The market does tend to get what it wants from the Fed. I don't think there's been an instance this cycle where what the market was pricing didn't happen at the Fed meeting. Mm-hmm. So if it's pricing 50 basis points, the odds of saying we're getting 50 basis points. I mean, the market has been really good this entire cycle of pricing. Some of the stuff we're reading is just people are talking about cuts within hours. It's just, people have just run home to the Fed for some sort of warm embrace when, maybe a little bit of caution is warranted.
Do you think that this sets us up for a sort of secondary stage of disappointment? I mean, do equities right now need that? Do bonds need it? I mean, the bond rally's been incredible as well. I've got to think that there is some serious expectations. I mean, this is where all these Fed funds get derived from. Is there volatility even in addition to kind of the coronavirus headline vol if Powell doesn't immediately cave?
I don't. If he doesn't do what the market says, you're obviously increasing the chances of volatility spiking. The way I would view it, and the way I think he would probably view it, is that if the market's pricing in 50 basis points for a meeting and he gives it to them, and the thing fixes itself within the next few months, he can just take it back. These aren't things that are permanent. If a 50 basis point cut is going to keep the market calm, that's a good idea. He can just take it back if this thing it really resolves itself by summer.
If, let's say, he does that, let's say we get tomorrow, hey, we're going to do the 50. Mike, do you think that the playbook of being bullish stocks as a result of that still holds?
I think what it does is it maintains sentiment. It keeps sentiment from completely falling apart. That cut is probably more about the nervousness of people. It's almost, giving somebody a cup of hot tea when they're worried about getting on an airplane flight. You're just trying to keep the market calm. I don't think it'll change any sort of investment strategies about or views of the market. I think that they're going to have to do it if the market demands it. The bond market and the equity market are powerful entities, and Jerome Powell is a powerful guy, but those are, everybody wants to wake up and be the bond market, essentially. Yeah. I think they're going to have to give the market what it wants just to keep it calm.
Yeah, act as appropriate is the wording that he used here. He's used it before, and it just seems there's a lot of applications being made about what that means, Mike. And if we do get a market that doesn't enjoy that, I mean, there's a lot of folks that obviously have been bearish on this for a while. You look at the way we ran up, the speed that we had, the amount of trading that was going on, the flows, the data on the economy. I mean, there's a lot of ways you could look back at this and go, hey, you know what? That was indeed the top. I mean, the last thought here, Mike, is what kind of probability do we assign to that right now? Is it possible that this coronavirus is the means to an end?
Well, I mean, macro shocks are really unpredictable. That's the thing. I mean, whether that is the top or not, obviously only time will tell. Our investment strategists don't believe that a recession is imminent. We're certainly not thinking about the end of the bull market yet. The 10% corrections do happen all the time. The speed of this one just happened to be the fastest in history. So we do have to acknowledge that. I would think that if this is going to be the end of the bull market, if this is going to be the peak was this year, you're going to have to see just an even bigger deterioration. You're going to have to see kind of economies grind to a complete halt. I think you would have to see the U.S. post data like we saw in China, where their PMIs hit the 20s.
Yeah.
Like, this is an incredible period. If that ended up being the top, 0 people take credit for it. Let's just get that out there.